Hello, everyone. I am Sarah Falvo, Managing Director of Business Development for Arcview Management Consulting, and I want to welcome you to our Arcview Access program. Mergers and acquisitions are a hot topic right now in the cannabis industry, especially as the headlines are announcing all different types of partnerships, acquisitions, and roll-ups. Today's economy offers a trio of favorable conditions for M&A, including a strong stock market, low interest rates, and, for the most part, available capital. Many entrepreneurs are starting their businesses with the end goal of a merger or acquisition, but both investors and entrepreneurs have questions about how to navigate M&A within cannabis. Today, we've brought together industry experts who can answer your burning questions about this timely topic. Before we kick it off, we want to thank our alliance partners who help make these programs possible and who provide incredible resources for the industry. And they include Ice Miller, who's participating today, Dwayne Morris, Green Growth CPA, Alpha Root, GrowFlow, Work, Zuber Lawler, Transact First, Waterton Partners, and North Star Financial Consulting Group. Also, a little bit about the Arcview Group. Currently, there are 3 subsidiaries. The first one is Arcview Capital, which is our FINRA licensed broker-dealer who offer investment banking services and now also offer a crowdfunding site for both cannabis and psychedelic deals. Arkview Consulting, which I am a part of, is our division that helps guide companies through various services such as growth strategy, state expansion, license applications, business plans, and pitch materials, as well as M&A assistance, both on the buyer and seller sides, which is very topical for today. We also have Arkview Ventures, which is our principal investing group that Gene Sullivan and Jeff Finkel run, along with our Arkview Collective Fund. They have made 15 investments in the cannabis space and have 78 investors. We welcome you to reach out if you have a company that you would like them to review. And just a reminder to find us on social media. We're on Facebook, LinkedIn, Instagram, and Twitter. There will be, if you have any questions during the program, please use the Q&A box at the bottom of your screen to drop your questions. It's easier to track them there than the comments section, so we look forward to seeing all of your burning questions. And we will also be launching a poll right now, so please make sure to take the short survey about future Arcview webinar programming. We'd love to hear your thoughts on all of that. And it is now my pleasure to introduce Chris Reese, Managing Director of Arcview Capital and moderator of today's discussion. I'll let you take it from here, Chris. Can't hear you, Chris. All right. We will give you a minute to kind of fine tweak these your sound. All right, just having a little problems with that. All right, well, as he is fixing that, I definitely would love to have all of our panelists come on screen. So if you guys can turn on your cameras and we will go ahead and introduce yourselves. So we have Nancy Whiteman from Wana Brands. We also have Adam Kalasoff from Ice Miller. We have Heather Malloy from Ulu Capital, and we have Jamie Mandola from Air Wellness. So let's see. Let's start. I'd love for you guys to all unmute yourselves and just give a little brief bio and introduction about each of yourselves. And let's kick it off with Jamie. How about you, Jamie?
Hi, thanks for having me. I'm Jamie Mandola. I am the head of strategy and M&A for Air Wellness, which is a publicly traded MSO. We're currently in 8 states, and we've completed about 12 acquisitions over the last 4 years since we formed the platform in this space. Prior to cannabis, I was a hedge fund investor, working in a couple of large funds, and then ran my own fund for about 4 years called Pacific Growth Capital in San Francisco.
Fantastic. Thank you, Jamie. And Adam, how about you?
Hi, everyone. I'm Adam Kalasoff. I'm a partner in the law firm of Ice Miller. Ice Miller has offices in 7 states. We're about 350 attorneys. I head the business group for our Chicago office, and my practice is mergers and acquisitions of privately held businesses.
Fantastic. And Heather, let's have you unmute yourself and hear from you. Oh, can't hear you either. It's one of those days. We'll give you a second while you connect, and then let's go with Nancy. How about you, Nancy? Give us a little background about yourself. Oh, we're having a lot of technical difficulties today. All right. Well, Nancy, we can't hear you or see you. And
Sarah, can you hear me now? It's
yes, Heather, let's go with you. All right.
All right, wait, I feel bad because I'm on 2 times now.
It's okay.
So, hey, I'm Heather Malloy. I've been consulting personally for the last, I guess, year and a half or so, primarily investing and doing a lot of strategic, financial, and some M&A consulting. Before I was independent, I ran corporate mergers and acquisitions at TerraSend, and I was pretty active in their corporate development group and started helping them build a U.S. footprint. And I've been active in the space in the U.S. regulated sector for the last 7 years or so, primarily doing capital raises, strategic consulting, and a lot of work around financing and raising money.
Fantastic. Always nice to see you, Heather. I'm happy you're on here. So it looks like we lost Nancy. I'm sure she's coming back on with her technical difficulties. And Chris, can we hear you now?
Yep, I got you. Yes, I know.
All right. So keep an eye out for Nancy, but I think we can go ahead and start the program. Thanks, guys, and thank you for everybody for bearing with.
Yeah, it looks like we got Nancy back. So Nancy, if you can hear us, maybe the other panelists have given a quick introduction. So why don't you give us a quick background and introduce yourself as well?
Will do. I'm Nancy Whiteman. I apologize for that little technical snafu. My computer crashed. I am the CEO of Wana Brands. Wana Brands is an edibles company. We're based in Colorado. We operate in 13 states in the U.S. and 9 markets in Canada, and are currently launching in 4 more states in the U.S. right now. So we have a real busy year ahead of us, and I'm looking forward to hearing everybody today.
Fantastic. Thank you, Nancy. And for those that don't know me, my name is Chris Reese. I've been in finance for the last 25 years now, with the last about 13 to 14 months over at Arcview Capital. And for those that are not familiar with Arcview Capital, we are an affiliate of the Arcview Group. We are a FINRA registered broker dealer. And we really have 3 different distinct business units. So think of one as a crowdfunding platform. Secondly, really going and focusing on fund distribution. And then third, an M&A practice, which leads us to the conversation today. And before we get into some of the details and begin the panel, I thought I would just shed some light for those that aren't familiar are keeping up with some of the statistics that we saw last year versus 2020, and then potentially where we're going to go in 2022. And 2021 was a very active year on the M&A front in the cannabis space. From a transaction standpoint, we had about 3.5 times more volume-wise deals than we did in 2020. So there are about 310 deals that were done last year versus about 86 in 2020. Many feel, and myself included, that we're going to see an accelerating pace of M&A as we go through 2022, because number one, we still have low interest rates, which is conducive to this type of activity. And secondarily, we have pressure on a lot of the larger companies to expand their footprint to help boost revenue. So we expect this to continue. Some of those larger deals that we saw in 2021 include Jazz Pharma acquiring GW Pharma, Trulieve acquiring Harvest, and then, of course, Canopy Growth and Wana Brands. And as we saw, kind of a spoiler alert, we'll hear from Nancy as well, specific to that agreement also. And so with that as a background, let me open it up and maybe start with you, Nancy. And I just mentioned the agreement with Canopy Growth. So maybe you could talk a little bit about that, talk about some of the reasoning behind the partnership and why you feel it was, and this is important, I think, to those on the line from an entrepreneurial standpoint, you're the best from a long-term strategic vision as you go forward.
Sure. Thanks. I have quite a bit to say about this, so I'll try to be pithy. I think it's interesting that the name of this webinar is Getting Ready for an Acquisition. And I know later we're going to be talking about a lot of the sort of logistics of getting ready for an acquisition. audited books and all of that good stuff. But I actually think from my own experience that a lot of getting ready for an acquisition is as much psychological as anything else. I think you have to start with really asking yourself the question, am I really ready to let go, or am I ready to be part of something else? And when the answer to that is yes, as it was for Juana, that we were ready to be part of something larger, then the question really turns to what is the right move? Who would be the right strategic partner for your company? And that process takes really some thought and effort and some time to work through. I think sometimes people get caught up in the pitching and the can we get a great offer and all the rest of that, and they need to really start with the why. What is it? What's the reason that you're doing this? And that really helps drive and rationalize a lot of the rest of the process. So in Juana's situation, as Chris mentioned, we did have a transaction with Canopy Growth Corporation of Canada in October. Ours was a little bit unusual in that it was actually an option to acquire, not a full acquisition. And I'll talk a little bit about why in some ways that actually I think is turning out to be a great thing. But we had gone through quite a process. We talked to many different kinds of organizations, everything from SPACs to PE funds to other large players in the industry, and even some large players outside the industry. And it was actually a very illuminating process to go through, because what it really helped crystallize for us and for me in particular was who is the kind of partner that is going to help Juana get where we want to go in the future. And to answer that question, you have to kind of take, I think, the Wayne Gretzky approach and figure out where the puck is going, right? Not where it is right this minute. And so for me, that really involved thinking about where the industry is likely to go, particularly post-legalization. And what I really saw is a situation where it's going to turn into a global industry, which means that we're going to be sourcing materials from all over the world, including THC. It means that dispensaries will no longer be the only game in town in terms of distribution. So I really was looking for a partner that had a very global perspective on the industry, and a partner that I felt could help us get where we were going better and faster than we could get there by ourselves. Now, why Canopy specifically? Well, one of the first places, in fact, the very first place that I always start is really on the values alignment and cultural fit. I think without that, you don't have anything long-lasting and sustainable. I often joke that Juana is my third baby. So this was very important to me, that Juana end up with a partner who I felt would be a good fit for us, both in terms of culture and values. And Canopy has very much turned out to be that for us. We really liked their global perspective. We really were very comfortable. And I will be candid, because of the Constellation connection, I had a concern initially that perhaps they would be focused primarily or exclusively on cannabis as an alcohol replacement. But I was very, very happy to find out their very deep resources and commitment to innovation and R&D on the health and wellness side of the business, which is very important to us as well. I also really liked the Constellation connection. I liked them for a number of reasons. First of all, the depth of the commitment that they made to cannabis, and the fact that it is clearly an important part of their own strategy going forward. And I also really like the fact that they are a company that understands brands and respects brands. They're one of the leading global players in the alcohol and beverage space. And the other thing that I loved is that they already have mainstream distribution set up, right? So they checked a lot of the boxes for me in terms of what I felt Juana was going to need as a partner. Again, thinking about where the puck is going in the future and where the industry is going. So, Chris, those are some of the reasons why Canopy ended up being a strong fit for WANA.
And it's interesting you mentioned the psychological aspect of it, which I think many people don't necessarily take into account as much potentially as they should. And I want to kind of stay on this particular theme, and specifically for those maybe on the line that are contemplating either taking on an acquisition or being acquired. And I guess we'll start, and feel free to everybody to chime in, but maybe we'll start with Adam from the legal front. But what today can a company do to be acquisition ready? Think maybe about the diligence process. What can they be kind of doing today to ensure that it's a smooth transition?
Sure. Thanks, Chris. There's actually quite a bit that you can be doing right now. For starters, you should think about establishing an internal team that you're going to bring forward if you go through an acquisition process, right? Assuming you're going to be buying a company, who's going to spearhead on marketing, who's going to assist with business diligence, and if you're on the sell side of it, who would a buyer likely want to be talking with? And there's always a tension about how big a team you set internally and the need for confidentiality. I would say that in a number of instances, owners err on too small of a team, and then they don't have the resources that they need to undertake the acquisition process internally. And when you think about a team, you've got the internal team. You also want to have an external team. You want to have a great set of advisors if you can get them, an accountant who's skilled in M&A and can walk through the financial and tax aspects for you, an M&A attorney who has experience in that area, and a investment banker or business broker. And there are, as Chris can attest, there are a number of reasons why having a FINRA registered one is advantageous. It allows you to enter into a number of different types of transactions. The thing that you can do is you can kind of get all of those advisors and internal team members together to kind of kick off responsibilities meeting and structuring to determine what are the goals, or are you achieving them through a traditional M&A transaction? Are there other ways to achieve them? Structure will often dictate some of the work that you need to do up front. For instance, licenses and permits. What we're seeing in the cannabis space is most of the acquisition activity is done via stock purchase or merger because of the transferability issues and licenses and permits. If you would approach the structure of the transaction in other ways, like asset purchases, for instance, are not as favored. And depending on that, what third parties are you going to need to deal with as part of a transaction? Are you going to be dealing with credit unions? Are you going to be dealing with landlords? Are you going to be dealing with material customers? And thinking about the timing and sequencing of how you're going to interact with those folks early on. Figuring out the tax implications of the structure early on so that you understand where you can and can't go is part of an overall transaction. And then, of course, if you're on the sell side, right, or the buy side, you try to role play and understand what is a buyer going to be thinking about, and how should I best prepare for what they're going to want to understand about my company, both from a financial standpoint, a legal standpoint, and from a business diligence standpoint. And what we see now is the norm is the way that information is communicated is through online data rooms that are hosted. If you have a broker investment banker, they'll assist with the process. Law firms will assist with the process, and sometimes companies undertake it. But it's a way that you can communicate with, a buyer is going to want to have a team of accountants, attorneys, and business folks who go through an online data room to understand more about the business and how it's structured legally and operationally and financially. and your accountants and attorneys can put together sample due diligence requests that you can then take and start to populate with information, and take a hard assessment of your business. Is it well organized from a legal perspective? Is your cap table up to date? Do you have good evidence of ownership? Are your permits and licenses in order? Are your contracts in order? Do you have somebody who does contract compliance? These are the things that you can sort through well in advance of a transaction, because they take a long time. You can take months to, if you decide, gee, we don't have good contract compliance, but we have a number of relationships, we'd like to clean that up. It's not an overnight process. Corporate minutes and records take time, employment records, I-9s, intellectual property issues. It's a chance to kind of do a lot of house cleaning in advance of getting into a transaction, because once you get into an acquisition, what will likely happen is an acquirer will send a list and say, here's our diligence request list, please provide this information. And then you're really under pressure if you're scrambling around to figure out that, gee, we don't have good corporate records, we haven't maintained the things that we should, we can't explain the structure and ownership of the business, we haven't cleaned up our litigation or other liabilities. So that's some of the preliminary stuff. We can talk a little bit more about fiduciary duties and things that you do as you really approach a transaction. Is that helpful?
Yeah, helpful. And I think great background and kind of pointing that out. I want to turn as well to maybe Heather or Jamie to kind of continue this idea of, from a consulting side or even from an acquisition side, what do you see, or what's the conversations that you're having around companies and helping them prepare for, or what you're looking for in an acquisition, and some of the ways that companies can continue to get ready for that acquisition?
Sure, maybe I'll start. I would echo some of the comments that Adam mentioned with respect to the efficiency of a company that's looking for a partner to have, their house in order. As you can imagine, most of the more acquisitive companies have reasonably small, groups. I have 3 folks on my team, and then we also leverage resources out of our finance and FP&A team. But when a company has an organized data room, when they have their financials in order, when they have a projection model ready, when they have a lot of the key contracts and supply agreements and employment agreements ready, it makes the diligence process much more efficient. And when we're stepping into a situation where you get 1 out of 10 documents, or it takes months, deals have fatigue in them, and there's a lot of deals out there. And so the resources to hang around the hoop for a company that's going to take 2 or 3 months to pull together the basic levels of information, that's not the best setup to ultimately get a deal done. Outside of just the nuts and bolts of having the information in order, just a couple other things that I've seen that might be, for whatever reason, a little bit different about the cannabis industry than other industries that I've been part of. It does seem like there are more situations where there are diverging interests amongst the ownership group. So it might be that the entrepreneur who may own a decent chunk of the equity decides it's the right time to sell or find a partner. And then as they start going through the process, they realize they're not actually on the same page as maybe some of the passive or minority holders, and they don't actually know what their rights are with respect to drag-along rights or issues with the operating agreement. And so just trying to be on the same page as much as possible with the relevant constituencies at the ownership or board or key employee level, that may or may not be everyone may not want exactly the same thing, but before you start engaging a lot of time, money, and expense, it's helpful to know where people's agendas are with respect to that perspective. And then the last thing I'd say is, as Nancy mentioned, really understanding what you're looking for. Someone with one dispensary might be just looking to sell it and move on and work on different things. Someone that's a brand or a regional private MSO may be looking to attach their business to a larger platform. with better resources, access to capital, and the ability to grow. Maybe there's some ability for the seller to get a piece of that upside. It may be for liquidity. And so there's a lot of different things that may dictate what the right partner is. There aren't that many groups that are coming to the table with $300 million of cash. A lot of times you are going to get a lot of stock or other types of consideration from a partner. So doing the reverse due diligence on that partner to make sure that you're hitching your wagon to the right, group. There's lots of horror stories out there, right, over the last handful of years with Ianthus and MedMen and others, right? It doesn't matter if you sold your business for 50 million if you end up with zero or close to it. Making sure that you understand what role you may have or what role you may want to have in shaping the outcome of the business once it's ultimately acquired. So those are a few things that come to mind from my seat.
I think from some of the companies that we deal with, and we deal with a lot of some companies that are more startup, some that are a little bit more mature. And I think about the times when you're having a conversation with them and you start going down the path of why are you building the business to begin with? And what is it that you ultimately want? Is it that you want to continue to operate the business? Are you looking for an exit? Or are you looking to either list, go through an IPO, or specifically, are you looking to sell out, essentially sell the business to a larger organization? And when you think about that as a way of an exit, so one of the exit strategies would be an acquisition. And I'll open it up for anybody who wants to kind of add in here, but maybe the pros and cons of a strategic decision as an acquisition or being acquired versus some of the other exits.
Sure, Chris, I'd be happy to start. I've had clients that have said, I just want to sell, and they'll go through the process and get a really nice result, sell their business, work for a year or two, and then move on. And, a few years later, they'll come back and they'll say, I thought I wanted to learn how to play guitar and play more golf. And I've tried that and I'm not very good at either one anymore. And, I miss being a part of it. I miss having a team that relied on me, and I miss the hectic pace of it all. And so, it's different, right? And you lose control of what you started and you end up in a different role.
And I don't know, Heather, if you have any input or anything to add on thinking about that.
Yeah, so I think, I guess I've been talking to some folks lately that had thought that they wanted to sell their business. And then similar to what Jamie was talking about earlier, as we actually kind of got down to the heart of it, it's that the capital that had come together to actually launch the business had divergent goals. So some of the early investors in the cannabis space that I've, at least as I've seen anecdotally, have been real estate investors. And many real estate investors are really interested in clipping a coupon. And so once a business is throwing off free cash flow, they're pushing the founders to distribute cash on a current basis. And founders sometimes are looking for a bigger exit, or they want to become a cornerstone asset that starts rolling up other businesses. And so lately I've been doing a bunch of work with folks recapping companies and taking out, initial upfront equity that wasn't necessarily that they were aligned with launching the business, and they loved the idea of like a high yield return on a nice cash flowing asset, but they really didn't want to stay in the game long-term for growth. So I think that's been interesting because I think the equity markets have been hard lately and the debt markets have been flowing a bit more freely and rates have been coming down. So that can be like an interesting way for a founder to take back control of their company and ultimately think about what their goals are if they're not ready to either be acquired or become the acquirer. And then I want to throw back just to kind of some of the original stuff that we were talking about, because one of the things I thought was most interesting to me when I was doing a lot of M&A activity in the space is that like none of the companies that I was looking at were working with a banker or an advisor. And Jamie can probably speak to this as well, because I think he's looked at, got a lot more companies than I have. But a lot of those conversations, like the thing that's happening in a diligence process for the seller is a purchase price adjustment, ultimately, and a transference of risk. So when a company is bought, there's usually a look back period, at least this is my experience, where some amount of money actually goes into escrow. And if the acquiring company is finding that there's risk that they've identified that they're not sure if they're comfortable with, there's ultimately some sort of holdback or purchase price adjustment. And when we were working with people and they had nobody else on the other side of the table kind of counseling them, this was like a common topic that people didn't understand, that they weren't just collecting their money in a backpack and walking away, that there was like kind of a longer term transition that occurred when they were looking at selling the company. And some of the things that I thought were really interesting where we had points of divergence. So anybody that's looking at selling their business, some of the things I would think about are like, how good is your website and are you compliant with all state laws? And what is your working capital target? And where, if like a term sheet says a working capital target subject to mutual agreement with the company, address that like immediately and start talking about it now. And then what is the state license that you're trying to transfer and how transferable is it? And do you have any legacy issues? Like, was it a co-op? Did the co-op conversion happen correctly? Because some buyers will not take the outright risk of your license. And like as a buyer, I didn't want to take that risk. So I think sometimes it's like really thinking about when you're looking at these diligence lists, it's not just like a list of information that you have to provide. It's actually a potential risk sharing that you're going to ask your partner going forward to share in the risk with you. And it's potentially a purchase price adjustment that you need to be ready to accept. And so I think without a lot of people sitting and advising companies and people kind of doing it on their own as they have been, those are just some of the things that I thought, those were conversations I was having over and over again.
And it's interesting as you think about some of the deals in the marketplace, and you're looking at, quite frankly, a stock market, some of the public equities coming under pressure, but you also have market debt rates, and you referenced this already, still very low. What does it mean for stock deals as you think about cash versus deals that are done in stock? Will you see more that are done now in cash because of the depressed levels of the acquiring share prices? What are your thoughts on that?
Sure, I can give my thoughts because we're still out there, fairly active in acquisition mode. I personally think that you actually see a slight decrease in the number of acquisitions that get done, at least for the first half of this year, because what I typically see is when the public markets correct as much as they have in any industry, where I think most of the publicly traded MSOs, even the best ones, are down 60% off of their highs over the last year. And so I think generally a lot of the companies feel like their fundamentals are pretty good. Their stock is cheap. They want to be thoughtful and careful on how much dilution that they're incurring right now. The public markets aren't really open to go raise equity capital in any meaningful way. The debt markets are open. And so you've seen a bunch of companies, including ourselves, tap the public debt markets, which are available. But there's a limit on how much debt you really want to incur. We're still in a growth, capital intensive industry. I don't think we want to lever up dramatically. And so there's, the three ways to pay for something are cash, stock, and seller notes. And I think in a perfect world with equity markets depressed, you'd move more to cash, but cash has a finite limit in terms of its available capacity right now. So it's really threading the needle as well as possible, knowing that we aren't quite sure when the capital markets are going to totally open back up. And so I think it's the deals where, it's at a reasonable valuation and the group that we're partnering with sees the potential upside either in our company or the public MSOs more broadly. And they feel like when the valuations thaw, that they will have more upside being in a liquid top 5 or top 6 company than they might if they stay private and sell, down the line. Because there's no question there will be a point in time where the headline value for a private company will be more than it is today. The question is, will it be more than perhaps the stock that you are receiving at maybe the suboptimal time? And I think a lot of folks are saying, hey, look, yes, I might be worth 50 or 100% more at some point, but the MSOs might be worth 3 or 4 times more at that when those stars align. And so I think those are the deals that get done. And I think the companies that still think they're worth exactly the same price as 9 months ago, just there'll be stalemate and a lot of those transactions just won't happen right now.
Yeah. Heather, I'll turn to you and also ask Nancy to chime in on this. When you think about purchase price, and I know we've discussed this before, so a seller might have a purchase price of X, and a buyer is going to have a purchase price of Y, and so having those conversations early, managing expectations, liabilities, timeliness of money, and we kind of talked about that before. But how do you think about
All
I think we
right.
lost you.
I think we lost Chris again. All right. Let's see. It's one of those days. All right.
Can you hear me?
Well, yeah, now we can hear you.
All of that? Okay. So it was all right. So let me, and I'm directly plugged into the to a landline too, so Wi-Fi shouldn't be an issue. So if I fade out, just let me know, Sarah, and jump back in. But as I was saying with the purchase price, so as you think about companies that are looking to either sell or be bought, having those conversations early certainly is helpful, managing the expectations. But Heather, what are the conversations that you're having or guiding companies? And then maybe Nancy, as you thought about Canopy growth, having those conversations of coming together on what the actual purchase price is.
For me, I think it's so hard to make a generalization because it's still so regionally specific. And I feel like it's still so tied to what the actual underlying business is. And so cannabis touches so many different businesses. So in terms of giving people guidance on multiples of EBITDA or revenue, or if it's earlier stage and thinking about their GMV, I feel like it's really specific. And so it's hard. So you kind of have to look for comps that are relative to the specific market that they're operating in, and that there are so many disparate markets in terms of tech, cultivation, intellectual property, CPG brands, and the like. Like there's just tons of different industries sitting inside cannabis, and they all price so differently. And there have definitely been some outliers where it's like people have done really good jobs getting, great numbers. And then there've been some other surprises where it's like the acquirer, stole something. So, or so it seemed later. So I don't know that that's helpful, but I feel like it's really, really specific and it's hard to make generalizations. And I think having the public MSOs is interesting, but I do think it's funny when you look at the breakdown between revenue and just like how the multiples creep up as the revenue is going up. And so I think when you meet with some of the smaller single state operators that are doing great business and they're looking for 15 times EBITDA, you have to really quickly guide them down. So I don't know. I think it's great that we have the public markets, but I think it does result in some misperceived value in some of the smaller single state operators.
Well, I'll comment on that as well. So we are perhaps a little bit of a unicorn in the cannabis space because we are highly profitable, and therefore an EBITDA valuation was in fact what we were looking for. And we did look at comparables outside the industry in CPG, and then made what we thought was a realistic adjustment for lack of liquidity as a privately held company. And we had a multiple in our mind that we were working towards. And that was for us, our sort of guiding, our guiding light in terms of what we were looking for. And, that was also reasonable to Canopy. And so we were able to come up with a valuation that made sense for both sides.
And thinking about being acquired, and there's a couple of different ways that we can kind of take this question, but so some of the advantages and disadvantages of building businesses and specifically staying on after the acquisition. So ways to get creative and maybe talk through either Nancy or Jamie, if you want to jump in on this too. The idea of staying on after the acquisition and continuing to operate.
Well, I'm happy to jump in, Chris. In our situation, it was a given that we were going to stay in because there actually has not been an acquisition that's been consummated. But for me, I alluded to this in my opening comments, that has been an incredible blessing because it gives us a runway to really get to know each other, not just as a acquirer, acquiree, but really as partners, and to really get to know each other as people and as business partners. I consider it to be my job as the CEO to start really putting in the work to build relationships, to build bridges across the cultures, so that when the acquisition does take place, it's seamless. We don't have any big surprises in terms of, well, I didn't know that that's how you thought about X. We've had this sort of luxury of time, which I think we're both quite enjoying, to really get to know each other as partners and business people. So I think there's a lot to be said about staying involved post-acquisition, or in our case, post-option for acquisition.
Yeah, I think for us, I mean, look, we love situations. We think this industry is short talent. And so we get more excited about acquisition opportunities when we're picking up great partners and great folks. And that can help us not only integrate and help run the assets that we might be buying, but folks that might be able to add value directly or indirectly through the rest of our organization. And so that could be someone who's a great grower or is strong in genetics. It could be a group that has really strong processing and extraction expertise, or it could be folks that are great, strong leaders or general managers that we can use in other places outside of just the business that we bought. I would say it's a little bit easier, I think, for some of the entrepreneurs. I would say about half of our deals have included an earnout. And we tend to do that when the group is going to stay on and have some reasonable control over the operations that they've been involved in. And oftentimes it helps bridge the gap in value where there's an expected big source of upside, either through product expansion or geographic expansion, where the business might be one size today and is expected to be twice the size, next year or the year after. We're probably not going to pay full value for that growth. But the earnout structure tends to be a way to risk share between the group that has control over that self-help upside and has the ability to get that full economic value, or most of it, without the buyer having to put their neck on the line and with a little bit of asymmetry of information. So in the case where the group continues on, that tends to be a couple-year period. One thing to think about is, as an entrepreneur, and I think there's some of the folks here in this group, it's a really hard psychological adjustment going from an owner-operator entrepreneur to an employee. It's really hard. And it's one thing to do that for a transition for a year or two, but there's a reason why you don't see a lot of CEOs of cannabis or tech or consumer companies sitting inside the platforms 5 years down the line. It's a really different role. And I think people that have that itch in the bug to have a lot of control, it's just a little bit harder when you're in an organization with, thousands of people. So I think there's a natural life cycle to it. I'm sure there will be exceptions to the rule. But I think that situation where you get a couple great year opportunity to really transform the size and scope of the business with some greater resources, and then perhaps have an opportunity to have a different bite at the apple from another angle in the industry, tends to be a compelling value proposition for both their capital and their career.
Yeah, and Jamie, you bring up a good point with the scarcity of kind of talent in the industry, and so keeping these individuals on or maintaining them through the acquisition. What about, Adam? I'll turn to you from a legal aspect. Any comments on, or what we should be thinking about from a legal standpoint as you stay on and continue to grow the talent after an acquisition?
Yeah, I mean, to pick up on some of Jamie's comments, it can be challenging. Often the founders will have very different roles in the organization. The buyers will look at it and say, well, I own it now. I'm going to run it the way that I need to. A number of the transactions are structured not only with an earnout, but with some rollover and continuing ownership of the founders in the companies. and there are liquidity issues relating to that. There's usually a longer time horizon for the business than there is for the active involvement of the former founders. And so you have some nuances there that you really have to kind of work through, but it is a way that if you want to continue to be actively involved in the business and you believe that the best days are yet to come, you can share in some of the upside by continuing to have an interest in the results post transaction. You can as a seller, you can de-risk your investment by receiving liquidity on a significant portion now. And as a buyer, you can de-risk your investment by not overpaying for earnings that are yet to come or future earnings of the business.
And I want to go back to, and I mentioned this earlier, but with Nancy's opening comments on the idea of psychological, which it still kind of goes through my head, because a lot of times if you're looking to sell, you may be less likely to focus on some of those kind of softer intangibles, and you're just looking at what's the multiple I'm going to get, what's the backpack full of money I'm going to get as I sail into the sunset. But as you think about those listeners on the call today, and they're looking to maybe sell out to a larger organization, can somebody comment on maybe the cultural fit that, and this kind of gets back to the psychological aspect of really how to integrate from a cultural standpoint into maybe a larger organization, understanding the opportunities beyond just a quick sell or grow, and look at all the options on the table when you consider selling out to or being acquired?
Yeah. Go ahead, Nancy.
Oh, I was just going to say, I think that's so critical, because I think the cultural fit is ultimately where the magic is, right? And I think it's a delicate balance. And I think in the best situations, and I feel like we have one of those, the acquiring company, or the option acquiring company in our case, is really respectful of the other, of the brand, in our case, the brand that they've purchased. They understand that the culture that we have at WANA is part of our magic, and that you don't want to go messing around with that too much. So I think that's a really critical thing. On the other hand, I think that the company that's being acquired has to learn how to flex a little bit towards the other company as well, because I think that's really the most successful situation when there is both autonomy and the power of 1 + 1 = 3. So I think that's a really critical point, Chris.
Yeah. And Jamie, you were going to add something?
Yeah, I was going to say we spend quite a bit of time on diligence, getting to know the principals, and I think it is important to, I know it's been a little bit tougher during COVID, but to break bread, with the counterparties, get to know them a bit, personally understand what makes them drive, and understand where the shared culture is, and maybe where there are some gaps. Because I think if I were in the shoes of someone selling my company, I'd really want to understand how decisions are made, what level of bureaucracy might exist that may not have been in the past. Where do the senior members of your team have to go for approval versus, the autonomy you may have to continue to operate your business, and how the senior people at that company, how do they treat people? How do they manage, capital? How do they manage their balance sheet? There's been a bunch of strategy and financial issues that have caused some of these companies to go off the rails. So I think it's a very important issue. And I think it's something that a potential seller should make sure that they feel very comfortable, with, both in terms of the dialogue, but ultimately some of these things, making sure that they're reflected in the purchase agreement or other things, so that there's a little bit of operational and legal protection.
And it's such a good point as well. So you think about the cultural fit, which is so critical to the longevity of two businesses coming together and making sure that you can operate for the longer term. And then, to the point that Nancy's bringing up, and I kind of came back to the psychological aspect, but really just being able to be flexible, right? You got to be able to have some flexibility when you're trying to bring a company, or you're selling out to a company where again, there are certain things that you're used to that you might need to be a little bit more flexible than otherwise is the case. And so I think we're getting close to the end of our time today. And I think Sarah is going to come back on here, which there she is for our Q&A. So Sarah, I'll turn it back to you.
Thanks, Chris. There are a lot of questions about this, so let's just hop right into it. And it's an open floor for any of our panelists. So the first one is, where are acquirers finding the capital for these acquisitions? So, I mean, they're typically large amounts of money. So any insight into that? Jamie, you want to hop in?
Sure. Look, I think probably across the industry, I don't have the stats at my fingertips, but it feels like on average, these deals turn out to be 20 or 25% cash, 50% stock, maybe 25% seller notes or earnout. Nancy's transaction was, I think, 100% stock. So there's outliers in every direction, but I think it's much more common that particularly.
It's 100% cash, Jamie.
Or sorry, 100% stock or 100% cash. Sorry. I think it's, I think it's pretty typical that sellers are going to get a portfolio of different consideration. And that's why understanding your counterparty is so important. And like I said earlier, the spigots and the capital markets are tight right now. Most publicly traded companies, I think, either can't or won't want to go sell equity. And so the access to cash directly from the stock market is limited. The debt markets are fairly open for the better capitalized companies. So that's one avenue. And then the rest of it tends to be paper.
Great. Thank you. And Heather, this is probably an appropriate question for you, but what is your outlook for the M&A market and capital raising market for 2022?
I don't know that I'm the best person here to talk about this. I feel like Chris and Jamie might have more insight than I do. I don't know. I'm waiting for February of 22 to be like February of 21 and like to see a full recovery. Because right now I can't even look at my portfolio. I have my eyes closed. I'm just like looking away. So I don't know. I mean, I hope that it only gets better from here. I think there are some like nice businesses growing in some of these nascent markets that are going to be able to take their time and kind of grow, and will hopefully be in stronger positions for later M&A. I'm really curious about watching on the Northeast. I think that in New York, I know that there was a license in play and it was like a very, very heated and hot process. And I think it's interesting when you're seeing what happened with Ascend and MedMen and, kind of people re-looking at some of the values in some of these markets. But I don't know. I don't know how the market will be in aggregate. I think Jamie probably has a much better pulse than I do.
Jamie, feel free to hop in.
Look, like I said, I actually wouldn't be surprised if there's a slowdown in M&A for at least the first half of 22, because you had such a drawdown in the overall equity markets over such a short period of time. It takes a little while for the private company multiples to adjust, and particularly if companies don't have a gun to their head, they may just say, you know what, now is not the best time, to sell unless I'm actually interested in taking stock and getting, beaten down in stock at great values. Then it might be, a really good time. It might not be the time to maximize the headline value of the purchase price. And the broader market, the broader markets outside of cannabis are also sort of in disarray right now. So I tend to think that M&A slows down when the markets are really volatile, and then it sort of picks back up as things stabilize, even if it stabilizes at this level. So I think you'll see more in the back half of 22. I think you could see, I know there's a lot of interesting creative discussions about how to build scale. And so I think there's a lot of folks having early stage talks with one another. But these things all take a long time to go from nugget of idea to consummation of a transaction. And I think the capital raising side is going to be hard. I think when you see the top 10 companies start to struggle a little bit with access to capital, I think it flows down. And outside of small amounts of money, like single digit millions, I think you can pass a hat with friends and family and smaller family offices. But I think that $10 million plus capital raise outside of the top handful of businesses that people think are high quality and growing very well, I think it's going to be a tough environment for a while.
Great. Thank you, Jamie. And then the next one. Oh, sorry. Go ahead.
I was just going to say, we're seeing a lot of activity kind of on the lower end of the market, especially some consolidation in license holders who maybe weren't pursuing operating businesses in the Illinois market. So it's an interesting time as well.
Absolutely. Thank you. And the next one, are there different strategies for an ancillary business that is not plant touching, just from the back end? And it's okay if nobody has any answers. All right, we're going to move on to the next one. How risky are SPACs in 2022? Is it a valid avenue? And this is an open floor, so feel free for anyone.
Maybe I'll just start. I thought they were risky in 2021. They're difficult to truly understand. The promoters have a large advantage. And if you look at the data that's come out, a number of them, the investors have not been served well by investing in them. There's obviously exceptions on both sides, but it'll continue to be a funding mechanism, and it's one that I think should be used with some caution.
Absolutely. Anybody else?
I mean, I think, again, outside of cannabis, the SPAC market went from a pretty niche product until about a couple of years ago, and then has just ballooned. And so there are hundreds and hundreds of SPACs out there, maybe a dozen or so focused on the cannabis industry. And unfortunately, in this type of market environment more broadly, the investor interest in somewhat less liquid, more speculative, less stable structures, I think the performance by and large of all SPACs, never mind cannabis, has been pretty challenging over the last year or so. And as we go through this level of market turbulence, that doesn't tend to be the first place that investor capital comes back to. So I would proceed. It doesn't mean that they don't make sense, but you have to make sure that the cash is there. And so when someone shows up with $100 or $200 million SPAC, the question is, in this market environment, I'm seeing a ton of redemptions. And so what does that actually mean? So unless someone has some form of backstop capital that they can actually deliver that capital to the ultimate portfolio company, it may be a little bit of a mirage with high fees. So there's always the exceptions, but make sure you do your homework.
Great. Thank you, Jamie. And the last question, and again, this is open for everyone, but thoughts on if federal movements such as the MORE Act to remove cannabis from Schedule I, will that significantly increase valuations across the sector? And should people focus on that or focus on waiting for full legalization? Thoughts on that? Anyone?
Look, I think
Jamie, you get the grand prize for that.
We saw a preview of what's going to happen to this market when there's any movement on the federal side, right? We saw this exactly a year ago when the market went probably a little too crazy on States Act chatter, right? And the market went up a ton, and now has gone a ton as the prospects for that, faded throughout last year, and now it seems like some of those prospects actually may be picking back up prior to midterms. But if we got MORE Act, I mean, look, the biggest problem in this industry is how narrow the breadth of the available investors are. I mean, we've been talking to public market investors for 4+ years. 75% of them are still the same as 4 years ago. I mean, there's a small handful of new folks in the industry. A lot of the people that have deployed capital, unfortunately, because the returns haven't been amazing, it's not like their track records are so great that they can go raise more capital around it, and they're pretty small to start with. And so we're just sitting there talking to the same 20 or 30 groups, when if you're a tech or a consumer company, you're talking to 1,000. And so the supply demand of capital flows, I think, will dramatically increase valuations when we get some momentum on the federal level. But I just hope this industry doesn't turn into a speculative version on federal, prospects, because we all know no matter how much homework you do and how many lobbyists you have and government affairs people, no one has any idea. There's so much dirty stuff that happens behind the sheets and horse trading with totally unrelated things that I discount, even my own opinions, even when we spend a lot of time trying to figure out what's going to happen.
Absolutely. Thank you. And we all wish we had a crystal ball. I'll say that. I just wanted to thank everyone for joining us today, and a huge thank you to the panelists, Jamie, Adam, Heather, Nancy, for all of your engagement. And thank you, Chris, for moderating. And thank you again to the viewers for filling out our survey. And as a reminder, if you are interested in chatting further about M&A opportunities and possibilities for your company through our consulting group, Arcview Management Consulting, feel free to reach out to me, Sarah Falbo at arcviewconsulting.com, and we can have a further chat. And we have some upcoming events. Our next Women's Inclusion Network workshop will be held on Monday, February 7th at 2 p.m. Pacific, and that will be about risk mitigation with Meryl Gilbert, founder and CEO of Trace Trust. You can visit arcviewgroup.com/win to learn more about how to become a Women's Inclusion Network member. Additionally, we are launching a co-branded report in collaboration with Minority Cannabis Business Association and Weed Maps that will present nationwide coverage of social equity programs. Join us on February 10th at 1 p.m. Pacific for a special edition of Arcview Access as we walk you through the methodology and findings of this report, as well as use of the toolkit. You can register for that on arcviewgroup.com/events. And lastly, we will be hosting our first international town hall about the legalization of cannabis in Mexico and what that means globally for the cannabis community. Don't miss this exciting discussion on Thursday, February 17th at 1 p.m. Pacific. Again, registration for that program is on arcviewgroup.com/events. And with that, we'll close. Again, thank you for your patience while we had a couple technical hiccups, and we hope to see you at the next program. Bye, everyone.